Welcome to This Explainer. Today, we're breaking down one of the absolute most fascinating corporate dramas playing out in the markets right now. We are talking about the rapid, massive transformation of British American Tobacco. This is a sprawling legacy company desperately trying to navigate its way out of terminal decline, and they're doing it right in the middle of some intense corporate turbulence. So let's just dive right in. To really set the stage here, let's think about Warren Buffett for a second. He famously has this incredibly simple philosophy. When he dies, 90% of his estate should just go into a low-cost S&P 500 index fund. You just buy the market, set it, and forget it. Keep it simple. But what happens when you look at individual companies that absolutely do not have the luxury of simplicity? Well, today we are examining the complex reality of a 124-year-old corporate giant that essentially has no choice but to completely reinvent itself just to survive. And trust me, it is anything but simple. Quick housekeeping note before we get to the numbers. This explainer is strictly for informational and educational purposes. We're looking at an objective analysis of public data as of August 2026. This isn't financial advice, and it's definitely not an invitation to buy or sell securities. Always do your own research, folks. Okay, here's our roadmap. We'll kick things off with Beyond Traditional Tobacco, then cover the massive shakeup, dig into the financials in By the Numbers, weigh the bulls versus bears, and finally wrap up with the road ahead. Section 1, Beyond Traditional Tobacco, Shifting the Core. So when you hear British American Tobacco listed on the FTSE 100 as BATs, you probably just picture legacy cigarette brands, right? Things like Dunhill or Lucky Strike. But actually, this is a sprawling global enterprise with 47,000 employees, and they are pivoting incredibly hard toward a smokeless future. They call this portfolio their new categories. Basically, we're talking about their non-combustible products, Vuse Vapor, Velo modern oral nicotine pouches, and their Glow heated tobacco devices. And what's wild here is the sheer scale of adoption. These are not just little experimental side projects. These new category products have rapidly built up a user base of 35 million people globally. And, 35 million users will dramatically change your financials. In the first half of 2026, almost 1/5, literally 19.8% of BAT's total group revenue came directly from these smokeless products. They are fundamentally rewiring where their cash comes from. But, as you can probably guess, rewiring a 124-year-old machine is going to cause some sparks. Which brings us to Section 2, the massive shakeup, a summer of chaos. Getting 1/5 of your revenue from entirely new product lines simply doesn't happen without some major friction. The push for this smokeless future led to some very sudden, very intense corporate actions over the summer of 2026. The sheer speed of this shakeup is what really rattled the market. Over a span of basically 5 weeks, it was like a domino effect. On June 29th, they announced a massive restructuring called Fit to Win. Boom. Exactly a month later, they dropped their half-year financials. Boom. And then just 6 days after that, on August 5th, the CEO steps down immediately. Let's break down exactly what went down here, starting with that first domino. 9,000. That is the number of employees caught up in that June Fit to Win announcement. BAT initiated a massive AI-driven restructuring program that is slashing 1/5 of its entire global workforce. The strategic goal is to get agile and save an estimated £600 million every single year by 2028. Make no mistake, it is the largest restructuring in the history of the company. The breakdown of those 9,000 cuts is super revealing, though. 5,500 of those roles were just entirely eliminated globally, while the other 3,500 were transitioned out to strategic partners, companies like Accenture and ITC Infotech. But there is a massive caveat here that is really important to understand. The United States market, which is BAT's largest and by far most critical market, was totally shielded from this reduction. They are cutting heavy? Absolutely, but they are protecting their golden goose. Which makes the bombshell on August 5th so incredibly shocking. Out of nowhere, no prior profit warnings, no activist investor campaigns. CEO Jack Bowles abruptly steps down after just 4 years. Leaving with immediate effect is a phrase that always spooks the market, and shares definitely took a hit. But BAT immediately replaced him with Tadeu Marroco, the company's finance director. Now, while the suddenness was completely jarring, promoting the finance chief actually gave the market a little bit of operational comfort. Marroco already knows the numbers inside and out, so there's less of a learning curve. Moving on to Section 3, By the Numbers, H1 2026 Financial Scorecard. Let's strip away all the corporate drama of a sudden CEO exit and just look right under the hood at the underlying business performance from that July 30th release.
Group revenue sits at a massive £12.235 billion. That is up 2.9% on a constant currency basis. Adjusted diluted earnings per share, that grew a very healthy 7.9%. But the metric you really want to pay attention to is that bottom one. New categories revenue shot up 18%. Now, I do need to point out one quick caveat. Their reported operating profit actually dropped. But actually, scratch that. It wasn't due to poor trading. It was mostly because of a one-off credit they got the prior year related to a Canadian settlement. On an adjusted operating basis, the underlying business is absolutely growing.
But that growth is definitely not spread evenly across the globe. We're seeing a very mixed regional picture right now. The U.S. market delivered a super strong 8.5% revenue growth, driven by both traditional and new categories. The Americas, Middle East, and Europe region, which they call AMI, was basically flat, but resilient at positive 0.9%. But the Asia-Pacific, Middle East, and Africa region, that saw some unexpected softness, dropping 6.3%, largely due to destocking in Japan and some challenges over in Bangladesh.
Yet, despite that regional weakness and the chaotic summer, the new CEO wanted to make one thing crystal clear: £1.3 billion. That is the size of BAT's share buyback program for 2026, and management confirmed it is entirely on track. They are just continuing to return massive amounts of capital straight to shareholders.
Section 4. Bulls versus Bears. The market divide. So how exactly is Wall Street and the City of London digesting all of this? Well, there's this fascinating tension right now between a consensus of very optimistic analysts and a few standout skeptics. There is a massive divide in price targets. On one hand, you've got major firms like UBS, Jefferies, and Bank of America maintaining buy ratings with really bullish price targets well into the 5,000 pence range. We're talking roughly at 20% upside from August trading levels. UBS even called it a top pick. But then, on the other side, you have RBC Capital sitting way down at the bottom with a heavy sell rating and a deeply bearish target of just 3,800 pence. So let's objectively weigh these two viewpoints. The bull case points to the undeniable reality that BAT is generating incredible cash. I mean, they are offering a highly attractive 5.4% dividend yield, all while successfully growing these new smokeless categories. To them, it looks like a classic value play. But the bear case, championed by RBC Capital, warns about the mechanics of the pivot itself. Yes, new categories are growing, but they inherently have lower profit margins than traditional cigarettes. It creates this adverse margin mix, meaning, ironically, the more they succeed in their smokeless pivot, the more their overall profit margins might get squeezed. Plus, some of the bears argue the stock is only cheap because of major structural headwinds.
Which leads us to Section 5, the road ahead, navigating the risks.
As the new CEO tries to hit that full-year guidance of 3 to 5% revenue growth, the company has to walk through an absolute minefield of risks. First up, the US FDA has been incredibly slow in approving new vaping products, and that's opened the door for illegal products to just flood the market. Second, they have to fix that weakness in the Asia-Pacific region we talked about. Third is that exact transition margin pressure the bears are so worried about. Fourth, you have your standard geopolitical volatility. But it's this fifth point that is uniquely challenging: ESG institutional divestment. Basically, many large funds have simply blacklisted tobacco stocks for ethical reasons. That acts as a mechanical headwind, keeping the stock's valuation depressed, pretty much regardless of how much profit they actually generate. Even with all those hurdles, CEO Tadeu Marroco is projecting absolute confidence. He recently told the market, "We are building momentum as we transform." He is clearly banking on the fact that slashing 9,000 jobs and heavily promoting brands like Vuse and Velo is going to create a much leaner, future-ready company. And that leaves us with the million-dollar question. Can the momentum of this historic transformation actually outpace the severe regulatory, margin, and competitive hurdles standing in its path? It's basically a massive race between the rapid growth of their smokeless products and the terminal decline of their legacy cash cow, all happening while the company undergoes its biggest internal shakeup in over a century. It is just a fascinating business case study, and we are going to be watching very closely to see how it all plays out. If you found this breakdown valuable and want more deep dive explainers just like this one, be sure to hit that subscribe button. Keep learning, keep questioning, and we will see you in the next explainer.